Hey everybody, welcome to this week's NASDAQ Dorsey Wright podcast. My name is Will. I got Joseph with me. We're recording this Thursday, March 16th at 11:30, coming out March 17th, Friday morning. Joseph and I were going to do like a 5 charts for the week type of podcast discussion. Admittedly, we're going to cheat a little bit and put 2 charts together twice to call it 5 charts a week, but we think it'll be helpful. So just going straight into it, I think first one on the docket, and this will makes more sense as we talk about the rest, is going to be interest rate focused. Talk about some volatility, then talk about specifically the US 2-year. And before we got on, Joseph, I know the MLMOVE was something that you were sharing about, right?
Yeah, so that MLMOVE, which is essentially like a treasury bond VIX, looking at the bond market volatility, that reached its highest level since 2009. Pretty much spiked from about 100 to 170, actually even eclipsed its 2020 peak. So that speaks to the just the magnitude of the rate volatility that we experienced over the last week, on the back of the some of those regional banks collapsing, and that led to just major repricing of what is the Fed going to do with rates moving forward? Are they going to have to cut now at the end of the year? How much are they going to cut? So once all that had to get digested, led to just a massive amount of bond volatility. And, you were talking about, if you're looking at the US 2-year, I mean, that moved to a sell signal down to below 4%, and it was at 5% earlier this month. So a huge move in that 2-year treasury yield.
Yeah, I've seen some people around the FinTwit community talking about, I think the US 2-year move, that's like the biggest move in like a 5-day stretch since 87.
Yeah,
or
something like that.
Something like that, yeah. On the US 2-year as well, this is a weird thing to notice, but the last time that gave a point figure sell signal was March 2020. Admittedly, the chart was down south of 1% at March 2020. So take that into consideration and with a grain of salt, but it's notable for sure. And then back to your point about the MLMOVE, just talking about rate volatility, you could also say like the VIX is a fear gauge that we like to say. So even with the MLMOVE, you can see like a lot of fear being priced in to the bond market as well. I don't know if you can say there's more fear than 2020 or as much fear as 2009. I don't know if you can make that comparison or not.
I think part of it has to do with expectations with what they're going to do with rates moving forward from the Fed, whereas in 2020 we knew rates were going to be really low for a while. Now you're dealing with inflation. You're expecting the Fed, you were starting to price in 50 basis points at the March meeting, and now you're pricing in between either no hike or 25 basis points. I think 25 basis points is still favored, but further out you're looking at the market wasn't pricing in rate cuts until 2024, and now they're pricing in maybe 75, 100 basis points by the end of just this year. So just I think that led to the just the amount of volatility that we saw in the bond market, was just those expectations shifted dramatically almost overnight.
Yeah, that makes sense. Yeah, the change in that expectations is definitely what dictates price movement, less so what actually changed structurally in the market. Yeah. Well, cool. I think that's what we want to hit there. Any other thoughts before we move on?
No.
Cool. All right, next one, and this is related. I think a lot in the past week has just stemmed from rate volatility and the moves and interest rates, and again expectations. But XLK has been remarkably resilient. It's got a great fund score on our system, which is just saying that it's technically strong. It's trending very well against itself and versus all other funds. And just looking at the trend chart as well, still on a buy signal, holding support at 136. We had a couple of reasons kind of why we think this is the case, but kind of 2 of the short ones being a bit of a flight to safety and rate focused as well.
Yeah, I mean, I think lower rates is historically good for growth. I don't think anything's really changed there. When you talk about why a lot of those large cap, growth stocks haven't performed very well, they have to deal with higher interest rates, which is usually not a good thing for growth stocks. But once that changed, and then you also have just, you have the regional banks are a lot of small cap focus. We'll get into a little bit, but commodities sold off pretty heavily, which affected some other sectors too. And if you're looking at something like Apple, which has billions of dollars just sitting around in cash, that's kind of viewed as a safety play versus the small cap space, which was actually in the value space, which it had been in a leadership position for a while and still is by a slim margin, I would say. But we definitely did see the tech and even the consumer discretionary space hold up much better than those value areas of the market.
Yeah, and you mentioned the consumer discretionary space as well. XLK, then like the Qs. This isn't in our 5 charts, but the Qs could be synonymous kind of with XLK here. You got a lot more consumer discretionary exposure in the Qs, but also held up much better. You actually saw, I think, like future, like NASDAQ Composite was positive, where the others were negative. You saw a huge spread between RSP and SPY. SPY, of course, having a much heavier presence of tech than RSP does. So a lot of different ways to look at this, but XOK was definitely a standout to us this week, holding that support and being that flight to safety, at least for your kind of mega cap US equity space.
Mm-hmm.
All right. Any other thoughts there? You want to keep chugging?
Keep going.
Keep chugging. All right. What do we got next? ITB.
Yeah, home construction.
Yeah, this is another ETF, similar language as actually I'll say this, similar chart setup for XLK, holding a double bottom formation 66, solid fund score. It's kind of been a head scratcher for me about home construction, that space just holding up really well amid all of this.
Yeah. I mean, I believe the housing data that came out this morning, Thursday morning, since this will come out on Friday, was actually pretty strong. So that could be a
like new sales.
Yeah, like new starts and stuff like that. The data came in pretty strong. And this has been a fund that's trended actually pretty well for a while. So I still think if you look at XLK, there's still this, you're still you're not trading above the June high. You're not near the August high yet. Whereas when you look at ITB, I mean, that's trading well above both of those levels. It's on 6 consecutive buy signals now. It's kept this trend line, very well. So just a lot of strength here, which is a bit surprising given the kind of the macro environment, what the Fed's been trying to do, at least with trying to get shelter costs down. But the home builders just have been great from a technical perspective.
Yeah, they've been fantastic, and I think that we could probably loop this back into our first chart talking about interest rates coming down, typically aiding some of the home builder space and the demand side of the equation, not stifling demand for these types of services and products. And if you look through those holdings of ITB, I know we've had a number of these in our call recs and in the report the past couple of weeks, but DR Horton, DHI looks fantastic. Lennar looks strong. NVR, all of those are among the top 3 holdings. DHI is a huge holding. I didn't know that's 15% of the fund, and then Lennar's 13%. So between those two, both looking really strong right now. So that's a space that if you're looking for maybe not your large cap growth, you want to get something that's still technically strong, but not maybe as sensitive to some of the rate movements.
You want to move on to crude?
Nothing else. You really.
I really want to talk about crude. I love crude. Yeah. So, I mean, we've seen crude trade in this low 70s to low 80s range, just $10 range, pretty much since the end of last year, and then just had a big blowout to the downside. I mean, part of that I think most of it was just induced to kind of the panic of. Are these banks going to fail? Is the economy going to slow to a halt? Yada, yada. That all happened in like 2 days before the Fed said, we'll back deposits and all that kind of stuff. So it's rallied a bit off of its low. It got down to, I believe it got actually a little bit below $66. It's back around 68, I believe, today. So we'll see what happens. I think when you look at it from a tactical perspective, you almost have like a blowout of this big consolidation area, which is kind of what you expect. You expect these big moves once you break out of consolidation. The bigger the range and the longer the consolidation, usually the bigger the move out of it. So we got this big blowout, but it was kind of driven by some market panic and some big shifts going on underneath the surface in the fundamental area. but not necessarily that could impact crude demand long term, as long as things seem to be heading in the right direction. It seems that most of the stuff has been contained so far. So we'll see if that peak panic kind of subsides. And I'd be interested to really see if, around that $73, $72 level, if it's crude's able to regain that, what happens after that? Because you got all this selling, probably a lot of longs got stopped out. So now that those positions are kind of cleared out, if we're able to get back above that 73, 72 area, it'll be interesting to see what goes on and what kind of impact that has on the energy equity space too, which we're not going to really touch on too much, but that's an area that I think got hit even harder than financials did over the past week or two.
Yeah, that's an interesting take. People probably wouldn't have thought
Yeah.
energy got hit as hard or harder than financials, but yeah, that's definitely true. I talked about that a little bit in our report yesterday. All those energy funds, individual stocks, just getting blown out of the water, and they were doing fantastic for so long. Really strong pictures. On the crude point, I would note that. So you said we got below 66. Your December 21 lows were like 63. And then beneath that, you got a ton of support between 58 and 62. So you were bumping up against some really key support. All of that came in like the middle of 2021. So not to say that, and I've said this a lot on recent calls, you can't go back too far looking for support on charts because you have different buyers and sellers, very different market dynamics where
especially in commodity markets,
especially commodity markets, where you can't necessarily hinge yourself to that support level, given it's structurally changed and the buyers and sellers have changed. But in terms of market memory, it's still price movement, and people behaved similarly at those points in time. So you bumped up against some key support. It's very oversold as well right now. So I think you definitely could see a bounce and maybe a revisitation of that old range.
Yeah. So I think if we get back to that 72, 73, I'll be very interested to see how it acts at those levels.
Yeah. Lincoln, another commodity. I know we're in 5 charts. This is our cheating where we're putting a second chart together with this. I think copper is probably worth talking about as well in the commodity space. If we're talking about crude oil being tied to the economic health globally, copper, second consecutive sell signal, broke its positive trend line. That positive trend line was in place since October 2022, so pretty much from those lows. And it hugged it a couple of times, like November, you got close, January, you got close, and then we recently broke through that. You typically don't want to see copper breaking down if you have a healthy economy on the horizon. And same thing with crude oil. You don't want crude oil to go to $50.
Yeah.
And
usually those are not great environments unless you're talking about, maybe the shale revolution like 2014. But, in 08 when crude blew up, that was a pretty bad sign.
Yeah. So point being that you're seeing some economically sensitive commodities have some material breakdowns. So I think if you want some confirmation for the economy and then the market as a whole, you probably want to see these find a bottom sooner
rather than later. And we'll see again, you talk about just a super news heavy week with a lot of uncertainty going around. Stuff just even stronger stuff like copper, which had been trending really well. Stuff like that can get taken to the woodshed too. So I think it's important to see if there's any real follow through to the downside after this or not. And, I think if you're talking about it just from a technical perspective, you have to take it a little bit with a grain of salt because of that fundamental movement, those fundamental changes, which led to a lot of the price action that we saw.
Yeah, sir. Certainly fair. Cool. All right, last one.
Yeah. Hopefully we can try to end on a little bit of a positive.
Yeah, this one I think it could be a lot more positive.
Yeah.
So this is one of our indicators. We'll put it on YouTube. For those just listening, we'll explain it as well. This is a bullish percent for the S&P 500. It's essentially measuring the percentage of stocks in the S&P 500 that are trading on point figure buy signals. There's a couple of areas that we care about on this chart at the highs and at the lows. So above 70%, that's when you're getting into extended territory. Below 30% is where you're getting into washout territory. And just from personal experience and studying these things, they're really most helpful coming out of market bottoms and identifying some near-term market bottoms. You don't get south of 30% very often, and we just eclipsed that yesterday. I think you put a piece in the report, right?
Yeah, I wrote it in the Were You Aware yesterday.
In the Were You Aware yesterday. You can check it out. Joseph mentioned this with some more words than I'll use here. But the only other times in the past couple of years that you've gotten below 30%. So October 22, September, October 22, which was a near-term bottom for the market. You also saw it happen like late May, June 2022, which was another bottom, at least near-term bottom for the market. And then before that, you had March 2020. December 2018 was another one that you went below 30%. So it doesn't happen often, but the action point for us is going to be like, watch for that reversal up into X's.
Definitely watch for that reversal because it's at 28% right now. It can head lower because we look at a September, October timeframe, it got down to 10%. June, it got down to 12%. So there could be more downside for sure, but you really want to be watching for that reversal back up into Exodus as an action point. And just, if you're just looking at that chart over the last year, I mean, you see these huge swings, get above 70%, down below 30%, get back above 70%, down below 30%, and then did it just another time over the past couple of months. So definitely a very unique market environment. I think it's something where you say, you look at it, you have to be more nimble than you probably usually are. You have to be willing to maybe take some defensive posture once you get back above 70%, just to take some precautions. Once you get below 30%, you get those reversals. I think right now when you're looking at it and you're waiting for a reversal back up, we may get that today because the market's actually done relatively well. When you're in these areas below 30, but still in a column of O's, it's a great time to get a shopping list together of kind of like high relative strength, either stocks or funds. And once you do that, get that reversal, you have kind of a game plan moving forward of, where do I want to go once the market seems like it's starting to turn back upwards out of washed out territory.
I like that. Yeah, and it's not uncommon to see a number of reversals up from below 30 before you finally get some follow through. That doesn't mean you shouldn't take the first one. That doesn't mean that's going to be a bad entry point for you. You just may get multiple opportunities. And it's interesting, like with a pretty range bound market with most of the indices, pretty big range, but range bound market, this 70-30 line has been really helpful. Like you said, above 70, take some defensive precautions, because you can see right here, like August 22 and then December 22 was two times that were recently ran over 70, and both of those were some near-term tops as well. So in January 22, March 22 were two others. So that's another chart that I think was pretty key for us over the past week. Put that one on your dashboard or set alerts on it or however you monitor.
Definitely.
Cool.
Definitely.
Well, that's the 5 with an asterisk charts that we had.
5-ish.
5-ish. Yeah. Any parting shots?
No, I mean, I think we covered everything. I think when you start to get these kind of announcements, it can, panic can take over a little bit, but using something, especially like the bullish percents, is really useful in these type of environments to help you add some context. And once you get to those kind of washed out levels, you're like, okay, well, now I'm kind of like looking, when's a good time to buy? What do I look to buy and stuff like that? So I think continue to monitor it, but it does seem like, peak panic is behind us for now, at least. Who knows in a couple of months, but at least in the short term, it does seem like the market's trying to find some support around here. So we'll see what happens.
Yeah, I like these indicators and just technicals as a whole, because they'll tell you where you are in a market, not necessarily where you're going, but just like, hey, here's where we are. Like if you're on a map, here's the location. Here's when you've been here before. Here's what the market's done before. At this level. It's also going to be really helpful now to tell you when you're right or tell you when you're wrong on a position. And then of course, always just taking out some of the noise, because if you're trying to just do purely qualitative fundamental work here, it's going to be really tough to cut through to figure out what's true.
Good luck trying to figure out how many more rate hikes and when the Fed's going to cut.
Yeah. So more to be said on that, but maybe not on this podcast. So we appreciate the attention per usual. Reach out to us if we can be of any help. Otherwise, we'll be with you all next week.